Fundamentally, we invest money in order to see it grow and make more money. That's what investing is all about. And the stock market does that very efficiently, with an annualized return over the past 60 years of just under 12% per annum. But of course, making money costs money too. And just how much it costs depends on how it is invested. If it's invested in a well-diversified portfolio with costs kept as low as possible, you will be a more successful investor. Where it can all go wrong is when you're paying much more than you need to for the same returns. For example, say you have £100,000 to invest and you have a 40-year horizon. That is 40 years until you need to access your money, when you retire perhaps. You can invest this large sum of money in different ways. On the one hand, you could choose to be an active investor, entrusting your money to a fund manager who will buy shares and trade them regularly according to his or her opinion of how much money they can make in the short term. There are a number of costs associated with this type of investment. First, there's the ongoing charges figure, the overt costs that investors incur by investing in a fund. This includes the annual management charge along with other costs such as depository fees, custody fees, audit fees, registration fees, legal and regulatory fees. Together, they add up to 0.85% on a typical actively managed fund. Next, there's the turnover cost, which is the cost of trading, buying and selling shares. This adds another 0.54%. There's also the fees a financial advisor or portfolio manager will charge to build and manage your portfolio. On average, this is around 1%. And finally, there's the platform cost, the software that enables the advisor to manage the portfolio. This is an average of 0.31%. In total, this adds up to an average of 2.7% per annum. That might not sound much, but remember you're paying that again and again, year after year. And every year, hopefully your investment will be worth more than the original £100,000. If we assume an average market return of 5% per annum and take off the charges, this gives an annual net return, the return you actually get, of 2.3%. At this rate of return, your £100,000 has turned into just under £250,000 in 40 years. But the gross return before charges is almost £704,000. It sounds unbelievable, but it's true. You end up losing around 75% of the investment gain, but you take all of the risk. On the other hand, you could have left your money in an index tracker fund, which would have returned much more of that £704,000 back to you. There are some costs, of course, but index tracker fund management fees can be as low as 0.25%, with lower turnover costs of around 0.15%. After paying your financial advisor and platform costs, your total costs are 1.71%. After 40 years, you will still keep just over £365,000 of your money. That's almost £117,000 more than you keep from an actively managed investment, which charges 2.7%, remember. As legendary investor Jack Bogle said, "In investing, you get what you don't pay for."